Hi, Eric. Please tell me about yourself.
Good afternoon. So just a little bit background. My name is Eric Chua. I'm Managing Director for Asian Wealth Community. We are an industry association predominantly for the private wealth community. Yes. My background is predominantly in banking. So I've worked for Bank of New York Mellon and Royal Bank of Canada, yes. In both investment banking and private banking. I'm also a fintech mentor for Startup Bootcamp, so I'm familiar with the impact of fintech and how it's going to evolve our industry.
That's brilliant. Thank you. What is your opinion on the current status of financial technology?
I think with the FinTech Festival last year, which MAS hosted, it's created a lot of buzz, which is good. Everybody's getting very excited.
Yes.
But at the same time, I think it's created a lot of noise. So it is important that FinTech will change the way we do business in the financial industry. But we do need to be mindful of what is the impact. We would have to evolve. It's not a revolution. So yes. I think that helps us gain a bit better understanding of how it's going to impact us, but also be prepared for FinTech as it evolve into different parts of the ecosystem and the business transaction cycle.
Yes, that's great. Thank you, Eric.
No, my pleasure.
Today, do customers trust humans or robots more for advice?
I think it's a very good question. I think it's not just a question of humans versus robots, it's whether customers trust the institution, right? I mean, one of the reasons why we have so much compliance in the world since the 2008 global financial crisis, both the trust in banks has been eroded. On the other hand, some banks are too big to fail, so that leaves us with a societal problem. And I think Bitcoin, cryptocurrencies is exactly that way, why it has suddenly become so popular and why is it very difficult to control, because it's a network where people trust the network more than an individual institution that might not have always the customer's interest at heart. Yes. And I think this is a completely, and in particular the blockchain, will completely change the underlying economics. And again, this is the question whether the current institutions are prepared for that shift in economic thinking and implication.
I think it's what I find interesting is the whole trust question, because trust takes so long to develop with another human being, and you can lose it in 2 seconds. And clearly the banks, particularly in Europe and the US, lost that trust at the financial crisis. I don't think it's as bad here. I think that people trust banks more in Asia than they do in Europe. And rebuilding that trust takes a long time, and I don't think that's happened yet in many centres. The other side of that coin is the technology issue, and I find that really fascinating. If you'd asked me 5 years ago or 3 years ago, do I trust the computer? Do I have my credit card details on the computer? The answer was probably no, I don't. But trust on a technology is very binary. You either do or you don't. And at the point that you put your credit card details and your CVV number into the computer, you are committed and you then trust it. So I think it's a really binary thing. I don't think it's going to take a long time to develop. But in many parts of using fintech, there's still going to be a lot of human interface. The sales point, the relationship point, it's all going to be human. Maybe not in the retail side. So you still need to have that trust with the organisation and the people. But I think with the technology, it happens very quickly.
I think there's another element to this as well, and that's the millennials. If you look at this younger generation, they trust the computer more than they trust people. And it's really turned around, because most of this panel, with perhaps a few exceptions, don't fit into the millennial group. We grew up in a time where we had to build the trust around the computers, right? But this younger generation, they already trust the computers, and in fact, they watched their father or their uncle or some family member lose substantially in the 2008 crash, or through some other bad financial investment advice. And they look at it as, I trust the computer more than I trust my father's broker, Jack, who do well, and who sold them all sorts of bad things during the crisis. So, they look at this whole process from a completely opposite question. Why should I trust the human?
You trust the network increasingly. It's what often referred to as the reputation economy. Right? It's the network.
Yeah.
You trust the network that the consensus of the network is
I think
getting a better outcome.
Anna's point that she was making before we started was important. I think what you were saying was that some people trust their advisor a lot. Other people trust technology because it's impartial. If 7 of us go to the same advisor bilaterally, call him up and say, hey, how should I invest my money? He'll give us different advices and we wouldn't know where it came. But the computer, if we fit in the same values, will give us the same results. So it does have a repeatability of the advice, right? And I think impartiality is one thing where the computers do win.
Yeah. And one of the biggest thing that we've been watching in this space is that in the next 5 years, there's such a big amount of generational wealth transfer. Those who are wealth holders today are in their late 60s. They have to pass it on to the next generation. And the next generations are in their 30s, 40s, some even in their 20s. And you will see that they don't believe how private banking or wealth management is done the old way, because they've never lived that lifestyle. They never feel that they need to be taken care of by a private banker. And like I said, it will change the way business is done in private banking, wealth advisory, wealth management, just because the habits are different. They've gone onto a digital lifestyle, therefore you have to cater to a digital lifestyle for them. So I think that's really one of the themes that came out, that we have this change in terms of going from what was analog to digital, and it's not reversible. Remember the days when we used to do fax and then we do email? Nobody go back to fax. Very few, I think. And telex is next to date, because why? It's shift. We've moved on, and that's really the difference.
I think that's a very good point, and also very important. And I think, as you were saying, it's increasingly sort of more of a hybrid model. I mean, robo-advisory alone maybe would not be enough, but it's a bit like not just virtual reality, augmented reality. So it is using robo-advisory with some human input. And the human input potentially becomes ever more important, because there was even a book written about this topic called Humans Are Underrated. That in a world where people have increasingly short attention span, trust increasingly is ever more important. So the human side of the equation comes out. And most probably it will surprise us all. I mean, that's the beauty about disruptive technologies, right? You never really know how it will pan out. But if you remember the 2000 tech bubble collapse, right? There was a company called Pets.com. They went from 200 to 0, right? And there was a company called Amazon, right? And the idea always was, look, more people in America actually have pets, and people betted on Pets.com because there are more people who love pets and pay for the dog food than people read. And again, so in hindsight, you should have betted on Amazon, right? But at that point, actually Pets.com was a very compelling argument. And I think we're seeing the same now, that how it pans out will be very different to what people might actually think.
But your take on who will trust more? Is this just age, or is it user sophistication?
Look, I mean, I thought about this a lot, and I think those people who realize that the world is fundamentally changing are willing to do that. It's not a question about age, it's a question about mindset.
Yeah, I agree. It's a mindset issue, and there was a very interesting report just came out by Accenture that I recommend everybody to read, and it's really fascinating because if you looked at the developing markets, particularly Thailand and Indonesia, they had the highest overall acceptance rates of wanting digital advisors anywhere that they polled in the world, and it was remarkable. So it wasn't a matter of wealth gap; it was a matter of aspiration. What do you aspire toward? And this group aspired toward the modernization of using cell phone, using technology to manage their money, because that was aspirational in part to what the future and modernization and becoming a first world, getting out of developing and getting more developed would get them. So I don't see it as just I don't see it as a rich-poor divide. I see it as a youth divide and as an aspirational divide.
Wanting to be with tech.
I'll take a different angle with this question about how we look at the adoption rate. I think it's more of an issue of habit. If among us today, you are now relying on Google to tell you where to book a restaurant for dinner, or which hotel will be good, because TripAdvisor gives you ranking based on that. That means you have already formed a digital habit, and you've already moved towards that. Now, obviously, the dollar sum that it's involved, it's probably a few hundred at the moment. But where does it stop? Because obviously, then you are now probably using your smartphone to do trading, that's in tens of thousands and maybe even in hundreds of thousands by a few clicks, and that's already, again, increasing both the habit and the dollar value. And when you reach a certain amount of comfort level, then the dollar value doesn't feel anything. Doing $1 million on a digital platform and $10 by buying from an email has no impact, because it's the same experience. It's just a matter of whether you've gone to that. So at the moment, our analysis is most people are comfortable under 100 US for stuff that you buy online. But for transactions, e-broking and all that, people have already crossed anywhere between 35,000 to 50,000. People are actually trading and buying and selling 20,000, 30,000, 50,000 of stocks per order. So you could see that there is obviously a group that's an early adopter that's moving ahead. There are those who will insist and never use their credit card online, and that's a different tribe altogether. But you will see that those that's the early adopter has already moved ahead, and it's just how quickly that move. Each country would have a different profile depending on internet penetration in terms of how they interact among themselves. But this peer group, this tribal effect is very real, because if my friend books the restaurants online, I get heard about it, I will start experimenting with it and I'll start using it, and I'm never going to go back to making a phone call for a reservation anymore, because everything's done online.
So occasionally advice does not work out as expected. Don't humans do a better job in explaining?
I take the caveat, because any advice that's given, and including, nobody sees the future, so that's a reality. But I think where you talk about whether human can do a better job than an AI or what have you, or whether technology can do a better job, the answer is yes. I think technology beats us hands down, because you look at where we came from without technology and look at where we are now. How many of us would not be able to function without our smartphones? You rather lose your smartphone than lose your wallet. You lose your wallet than lose your smartphone, because you've got more valuable stuff in your smartphone now. Your life is in your smartphone now. But I think that the challenge is going to be in two areas. One area is obviously as the technology replaces people, then where do the people go? That's one very key issue that the industry needs to address.
Yeah.
And the other one is, where is technology being deployed? Now, I used to work for a bank and run projects, technology projects, and the bank only spent money in three ways. One, they were forced to, is regulation. Two, we are spending money because we can make more money, get more business. And three, we spend money because we can cut costs. So it's still very pragmatic. It's not changed in the last 20 years, 30 years of my career. So again,
what has changed is probably the budget for the compliance and regulations since the financial crisis has meant that any of the blue sky or the cost reduction stuff is out of the window, or in a lot of cases that's the case. So it's eaten up those budgets.
I think humans are better at explaining why something did not work well.
Yeah, but you see, look at this whole discussion, right? I think has to be seen on two levels. Think about it. Is the advice wrong because it was a wrong view on the market, or is the advice wrong because we made so much money on selling you subprime-related investments, where the internal view was that it might not be a quality investment, but the bank, none of them, many banks that don't exist anymore, made a lot of money by doing that. I think that's the key difference, right? So with regards to the question about is it human or is it the technology, I think you still need human judgment, right? And hence understanding where the system could be wrong. And I think it's on that level. But I think it comes down to this sort of incentive structure. I mean, for example, if you're an RM, do you get compensated for true advice, independent advice, or do you get compensated to sell high margin products? And I think this is where the sort of transition comes in, where increasingly with transparency, that question will be more and more asked.
Well, I think the regulatory framework, MiFID and other things coming along are really changing that concept of commission and how much money an institution can take out of a transaction. So I think what you really see happening is these institutions are going to become information providers more than they are going to be commission-generating organizations, because I think that model is really over, and the regulatory framework is all pushing it in that direction. So, if you're an information provider and your investment fails, does it matter whether a person explains to you whether it fails or whether the computer explains to you why it fails?
Well, I think one of the other critical things is one of the problems I see in the current sort of more manual approach model is that at times of crisis, it's very difficult to manage all of your customers. You can manage all of your customers on the average day, but at the point of critical moments, what will happen is people or relationship managers will concentrate on those top clients, maybe the ones that call, maybe the ones that complain, or the biggest clients. But they will never be able to manage and communicate sufficiently with all of the clients in those crises. The beauty of the platform is the fact that everyone is treated equally in terms of communication. And communication is constant. At the point that you want to find out what's going on, what's going wrong, etc., you're there. My experience of the financial crisis was those people that you're communicating with all the time were aware of the journey of the markets going down. Those that you didn't speak to for a week or 2 weeks had exploded and were very upset because you didn't have the communication. The platform, the technology has the communication as and when they want it. So the journey is different. I think.
Yeah, that's a. Why don't you go first?
No, my only comment is that yes, and the technology that you're talking about is advancing in leaps and bounds. And this is where AI, and you can either call it artificial intelligence or augmented intelligence, is really going to help. That interface that says, well, what is going wrong? I need answers. The risk platforms that we currently work on are going to change, and they're going to be queued into Twitter feeds and social media and unstructured data analysis. And they are going to be able to give users an up-to-the-minute dynamic look at exactly what's going on in the markets, and it won't be a matter of them clicking on 50 buttons to read the articles. It will be, hey, this is what the market is telling us right now. This is what the research is telling us, and that is really going to be the transformational experience that takes us out of. We're still asking the question, which is better, humans or machines?
Combination of things.
And the use of AI, which is still really relatively new in the robotic investing platform, that's going to really change the whole dynamic of this question, because we're still looking at generation 1 products in the robo-advising space. As soon as these chatbots come to use, as soon as risk is framed not just as a numerical valuation, but as a dynamic valuation of numbers plus data that comes, report data that comes in off the news medias and off all the wires, game over. It's really going to change everything, and that's coming.
We had an interesting comment because we obviously we're a family office managing some money, but we talked to other family offices. And the interesting comment was this, the debt would be happy, like what you say, we do a few trades, we trust our bankers, we are discreet about how we do our business, and obviously, when we score, we go and celebrate. The son has a different vision, is that firstly, we don't need to be entertained all the time because we are rich.
Exactly. Exactly. Yeah.
And secondly, why would I want to meet up with my bankers? I've got lots of friends, who are more interesting and younger looking and more exciting people to hang out with. Why would I want to hang out with my bankers who is 60, same age as my dad? I don't want to hang out with him. Why would I want to hang out with his banker? So I think this is again something that is a big concern, because if you look at, there's probably 3.7 trillion that's going to change hands. And these people who are inheriting the 3.7 trillion are going to use the services of the financial industry very differently.
Yeah.
And if you're not prepared, either you evolve or you die, because that's what happens to dinosaurs. And I think that you're totally right. It's not a choice. It's something that we have to constantly adapt. Maybe one real example, and that gives us a bit of context around, the guy with the phone.
With the mute switch on.
The mute switch on at the same time. Now, you've got to remember, we used to work very much with Citibank, and Citibank, some of the people that we work with always tell us, we are actually a technology company with a banking license. We are not a bank using technology. And the reason was they were very advanced in adopting technology, always ahead of the industry. And in Singapore, they were the first to install an ATM, and it used to cost $1 million for an ATM, and people were thinking crazy. I would pay $2,000 for a teller, then teller, why would I spend $1 million to do ATMs? But you see how it's progressed. Firstly, people stop going to branches because you have to queue to withdraw money. And Citibank did the investment for another very valid reason, because they didn't have a license to open as many branches they want. So they had to use ATM. It was a $1 million branch, but it was a necessary branch, wherever that they would be allowed to have it. So yes, so Citibank's staff in general are paid more than DBS staff. Yeah, it's because they are assigned to do more value-add stuff instead of counting money, taking money, and all that. And you see now most banks have deposit-taking machines or ATM dispensing cash, because this is not a profitable activity. You still have a branch and 10 tellers behind trying to count money and give money and get a stamp on your passport, the pass card, so that it shows that you have a withdrawal. It just doesn't work anymore. And yes, obviously there will be the tail end, but I think you will not want to be the guy with the phone with the mute button, because if you see this coming, you better be working with Citibank rather than the guy with the phone with the mute button.
You sort of created this caricature with the mute button. The base phone.
The honest truth is, these days very few people want to talk on the phone. I mean, people like to text. They prefer not to. My wife prefer to text me than to buy some milk home tonight. Call me, because we're all too busy trying to answer the phone.
That's the problem.
So you should take the guy that's having the phone at the milk bottle for a drink tonight.
Why? I have good friends.
But how does AI help augment human capability rather than replacing humans?
Sure, I guess that's aimed at me because the company I work for is big in AI, and really we're at a stage now where you got to think about what we like to call augmented intelligence, where it augments your human capability. We're not really thinking in terms of the computer making all of the decisions for you, but we're thinking about how a thinking cognitive system can allow you to review thousands of reports, look at huge amounts of documentation that you couldn't now. We're sort of in this information boom where basically we're all overwhelmed with the amount of things that we have to read every day. Well, same thing with your portfolio and looking at your investment. You can't possibly look at all these reports. So what we think now is in terms of augmenting, using a machine to augment what you are capable of doing and enhance what you're capable of doing. And that goes into the robo-advising space too, where AI can be part of the solution to, well, okay, you pick portfolios by basic analytics. Okay, that's tried and true for many, many years, but now we can use AI to actually help in being input into that analytical decision process to give your system a way of looking at the data, the reports, and the written data that's out there and make that part of the decision process.
I also think that in areas like sort of profiling of clients and risk profiling, the AI opportunity is huge in terms of the analysis. In the current approach to profiling, it's a few very basic questions, and from that you get put into a bucket. And I think with the AI opportunity and big data opportunity, you you don't need to have a bucket. Your profile can be particularly bespoke for yourself, and that's the scalability, and also it's going to be far more in tune with your desires and needs, and can fluctuate over time, where a traditional approach puts you in that bucket and you stay in that bucket until you get reviewed next year or the year after.
And how will AI help expand the retail investment model into new clients that never would have invested before?
I think it's opening up new frontiers. So this whole idea about geography, right?
Yeah.
And this is also not just about clients, but it's also about the legal concept, right? For example, many people still think they live on land. We live in the Republic of Singapore, right? Increasingly, with artificial intelligence and robot, many people live in the cloud. Right? There's completely different proposition if you live in the cloud, right? And hence you tend to have a much wider opportunity set. Yeah, you have a much more global view, and also this idea of what is an asset class is expanded tremendously.
Yeah, I think it would be interesting to understand, because that one of the biggest challenge when investing was price discovery. When we used to do trading in the good old days, the pool of liquidity was different and separated, and you had to go and use different means and different phones to find liquidity and price discovery, and the cost of that was expensive as well. Now, if we move everything to the cloud, like you say, and we all live in the cloud, the ability to be able to firstly be transparent, it's one. Secondly, it's being able to compare, and lastly, I think it is a very efficient price discovery mechanism.
And I think the thing that robos are going to do that's going to be very unique is they're going to allow people in developing countries to invest. They're going to be asset holders now. And there's a lot of up-and-coming peoples in places like the Philippines, in Malaysia, Thailand, and they now have money to invest, but where in the smaller villages where they reside, there's no bank, there's no money manager, there's no life insurance sales, and there's no place for them to save money for their kids' educations. And the robo platforms are going to give these people the ability to invest in markets and gain assets that they never had before. That's just a whole
and also more
separate
security, because they don't have to hold cash. They're not going to get robbed or all the other things that go with it.
Yeah.
It's simply they can do a transfer or a trade directly onto the mobile phone. It's secure in the cloud, one hopes, and they're going to be safe.
And this is a big story. This is the codization of money, right? I mean, many people. I mean, look at what happened to the telecom companies, right? Once Skype came, voice over internet protocol. Now it is increasingly more money over internet protocol.
Yes.
And that is also a significant game changer.
Yeah.
And what I've noticed so far, everybody talks about fintech. Still, in my humble opinion, sometimes they talk about fintech, but backward looking. Okay, we deal in United States dollars or Malaysian ringgit, right? When to some extent you should think about Ethereum versus Bitcoin or dark coin. And what I'm trying to say is that this sort of money over internet protocol potentially is one of the bigger game changers that people haven't really maybe considered enough.
I agree.
And I think it's actually transformational, because 3rd of March this year, Bitcoin's broke parity with gold. Right? Now, half the world doesn't know what Bitcoin is. The other half just kind of figure out different things about Bitcoin. But it's very important, because once you cross the threshold, it's like graduation. You play into a different field. And there are now very serious people that we work with who are setting up funds to invest in trade Bitcoins because they see it as an asset class. Obviously, the Winker brothers. Basically setting up an ETF. Why would you set up an ETF to invest in the virtual currency? But it's one way where people could get exposure to a Bitcoin, and they've probably got nothing better to do after they exited Facebook. So this was the next big thing that they're doing. And it's the reality. We will always go through a learning curve and a boom and bust cycle. peer-to-peer lending in China is bustling, but it's also broken. There's as much money being made, but there's as much money being lost. The government keeps a very tight eyes on it, not wanting to break the system or the industry. But yes, you're right. There are people who intentionally set up peer-to-peer lending, not intending to ever give the money back. But at the same time, there are efficient use of peer-to-peer lending in certain marketplaces in China. And that's where you probably have the winners and the losers over time. And I suppose the last word is, I'm told caveat, beware as a buyer, because it's a jungle out there, but and it might be winner take all, but nonetheless there will be some winners and losers.
That's great. Well, many thanks to our panel for a very delightful discussion.